Hello everyone, this is Ke Huang.
This is Kana.
This is Smith.
This is Yumna.
Today we're talking about the concept risk on and risk off. First off, what is risk on and risk off? Risk on and risk off are description of investors' willingness on risk. It determined by the investor action on their investment. When we're saying that in the risk on situation, we can say that the investors are more aggressive, they're looking for a higher returns, which means they're seeking high risk investment. For instance, the recovery period after financial crisis in 2009. Different from risk on under a risk off environment, investors are avoiding risk. They would like to put money in a safe place rather than invest them. The example of risk-off situation, we can think about the 1930s, the Great Depression. The panic of the economy make everyone conservative, so they would like to put money in a safe place. Japanese yen and the Australian dollar exchange rate is a good indicator of risk on or risk off. The determinants of Japanese yen and the Australian dollar exchange rate are no different from the other exchange rate. First is monetary policy from Central Bank of Japan and the Reserve Bank of Australia. And second is the major economy events. GDP release is the example of major events. And when we're looking at this diagram here, we can observe there is a significant decline from the end of 2007 to September 2009. After then, the exchange rate was climbing. Global economy stepped into the recovery period from the financial crisis. The climbing trend indicates a risk-on situation. Investors are seeking opportunity and higher risk investment. Vice versa, the Japanese yen and Australian dollar exchange rate was dropping during the financial crisis, which indicate the risk-off situation. As conclusion here, we can say that Japanese yen and Australian dollar tend to rise during a lower risk environment and tend to drop during a higher risk environment.
Now, I wanna introduce the Japanese economy. On this chart from 1985 to 2017, you can see three different colored polylines. The blue one is the policy rate. The policy rate is the key lending rate of the central bank in a country to regulate the availability, cost, and use of money and credit. The red line graph is GSEC. Its full name is Government Securities. The government securities are securities issued by the central government to borrow from the financial market to meet its fiscal deficit. As you know, securities are issued for short-term and long-term. The green one is called money rate, which is the benchmark interest rate that banks charge brokers who are borrowing the money to fund margin loans. So in this chart, what has happened to Japanese finance that made the volatility so strong around the 1990s? Let's take a look at the slide on the next page. Japan achieved rapid economic growth in the 1980s, especially in 1985 when Japanese stock and land prices rose sharply. Japan's exchange rate also appreciated. However, from 1990 to 2000, due to Japan's fragile financial system, after the bubble economy burst, Japan suffered a severe economic recession. Therefore, the Japanese economy has been in a state of low inflation since the second half of the 1990s. At this time, the Japanese economy fell into a situation where the effects of monetary policy were not fully utilized. So, what policies can help the Japanese economy? Here, we have to introduce the negative interest rate policy. The reason why some central banks adopted negative interest rates was in response to the global financial crisis triggered by the collapse of Lehman Brothers in 2008. Many central banks lowered interest rates to near zero. As there is little room for further interest rate cuts, some major central banks have adopted unconventional policy measures, including negative interest rate policies. Under this policy, financial institutions have to pay interest on excess reserves to the central bank. In other words, any excess cash that the bank must keep in excess of the regulatory requirements. In this way, the central bank will punish financial institutions for holding cash in order to encourage them to increase loans to business and consumers. On February 1999, the Bank of Japan adopted a zero interest rate policy to combat deflationary pressures. After the Japanese economic situation showed signs of gradual recovery, the zero interest rate policy was cancelled on 2000. Until 2016, in order to prevent an unwelcome strengthening of the yen from hurting an export-reliant economy, the Bank of Japan adopted a negative interest rate policy. Now, let me talk about the advantages of the negative interest rate policy. There are 2 points in total. The first point is negative rates help weaken a country's currency by making it a less attractive investment than other currencies, because a weaker currency gives a country's export a competitive advantage. Another point is that negative rates lower borrowing costs on a whole range of instruments. So businesses and households get even cheaper loans.
So now let's look at Australia's exports. So exports make up about 470.2 billion of Australia's economy. The largest sector of exports are minerals and fuels, with iron ore being the biggest exporting industry. The iron ore industry has recorded really strong revenue growth in the past 5 years, which is impressive since that includes the impacts of COVID-19. The second biggest industry is oil and gas extraction, which has also grown over the past 5 years despite facing high volatility. And other big exporting industries include coal, liquefied natural gas, gold, which is another very big one, meat, grain, aluminum, pharmaceuticals, copper, lead, and silver. So all of these things are a really big part of Australia's economy.
Hello, now I'll talk about other indicators to gauge the tolerance of risk. So risk tolerance differs from person to person, as risk tolerance is willingness of investor to take the risk while investing. Some of the indicators which can gauge the risk could be volatility in currency or financial market, which can lead investor to a big risk. Other can be monetary policy, which can change market sentiments and can also change the economic growth trend, which could lead to many other risks. The other is economic news, which can bring in the volatility in the market, which can lead to panic buying or selling in the market and could unfavor the investor's position. Okay, we'll move on to another slide. And here are the basic factors which could influence risk tolerance. So one is timeline. More risk can be accepted if investor has more time. Other is goal. High return could come with higher risk. And the other is age. Older individual would take lower risk than young one. And the other is investor comfort level, which differs from person to person. Thank you.
Thank you for watching. That's all for today.